expense in our percentage of sale method, but here this is allowance for uncollectible account, which means total number of allowance that should be in the balance here. Okay, we'll talk about that. So meanwhile, just try to digest the percentage of sale method. See you after 15 minutes after a short break. Okay, class, welcome back after the break. So let's start our next method, which is allowance method. And before going to the break, I told you there is a little slight difference between allowance method and percentage of sale method. And what was that? In percentage of sale method, the percentage of sale method, we multiply the estimated uncollectible multiplied by the sales revenue, and it gives us the answer expense, uncollectible expense, right? And it means uncollectible expense, and then what we need to do, we just add in uncollectible allowance here in 78 here, so total is 88 here, right? But in allowance method, we multiply the estimated uncollectible with the aging of the account receivable, the aging according to their amount of outstanding balance, that's it. Sorry, outstanding period. But it gives us allowance for uncollectible account, which means total balance of the allowance, not the expense. That is the difference. Okay, how we are going to find out the aging of the receivable here? Here we go. So let's continue our example. It's the same example here, right? So assume it's September 29, 2012, Apple Incorporation receivable account shows the following: year-end adjustment balance, account receivable 11,028, allowance. We still have allowance for uncollectible accounts, that is 10. We also call this allowance for bad debts. Bad. In some books, in some online lectures, or in some books, we also heard the name bad debts, allowance for bad debts, or reserve for bad debts. Uncollectible is called bad debts. Okay, so don't confuse with the words bad debts. It's the same, uncollectible accounts. Okay, uncollectible receivables. So let's continue. Apple Incorporation computerized accounting package ages the company's account receivable as shown in Exhibit 5.3, right? So let's see the 5.3. Here we go. So it means this is the aging. Aging means that 10,164 is going to be paid by the customer in 1 to 30 days. 31 to 60 days, how much is the outstanding? 600. 61 to 90 days, it's 200, and over 90 days, it is 64, right? And this is the estimated percentage of uncollectible. So these would be given to you. There is a whole new chapters, mathematical formulas, how to calculate this one. So we are not going into that one. But remember that one. The longer the period is, you see, the longer the period is, let me change the laser point here. So longer the period is, 1 to 30 days, 31 to 60 days, 61 to 90 days, over 90 days. The longer the period is, higher the chances of uncollectibility. See, 0.75%, 1%, and it jumps 1.1% to 5%, and then 5% to over 10%, right? So how we find out the balance of account receivable? You just multiply 0.75% of the amount due in 1 to 30 days, which is 76. Remember, You can round it off or you can just not round it off. It's up to you. Okay, so round it off to the nearest millions. So just round it off to it's 76 million. 1% of 600 million is 6. 5% of 200 million is 10 million. 10% of 64 million is 6.4. We just rounded off to 6 million. So total 9. So this 98 is the total balance of the account receivable. What does it mean? Let's move forward to see that. So what is the entry? It is the uncollectible expense to allowance for uncollectible. So what is the allowance against this sales? The allowance is total allowance is how much we need to create more allowance. 10 already have a balance here, right? 10 we have a balance here. And how much we need to have maintain the balance? 98. So it means 11,028. How much left after 11,028? 98 would be the bad debts or uncollectible expense. But how much reserve we already have? 10, right? 10, this reserve we already have. So how much new we need to create? 88. So that is the difference between percentage of sale and aging of receivable, right? So it means we need to, the percentage of sales just tell you about this 88, but the aging receivable tells you the whole complete balance, and you need to find out how much is the balance. You just less the balance and this would be the amount. So entry would be uncollectible expense to allowance for uncollectible, which is 88. 88 further we need to raise because 10 we already have, and we put it in our ledgers. So you see here 88 we need to create more, and the total balance is 90. So look at that, this 98 is exactly equal to the amount that is we find out through aging of receivable, 98. So this 98, this aging of receivable method tells you the 98, and this 98 is the total balance of account received, allowance for uncollectible account, right? And how much we need to create further? 10 we already have, this 88. So we need to make the adjusting entry of 88. So how much is we need to raise 88? Entry would be uncollectible expense to allowance for uncollectible. So now let me ask one by one. Now you understand, Harry, the difference between percentage of sale and aging of receivable?
Yeah.
Marilyn, you understand?
Yes.
Nam?
Yes.
Pinyo?
Yeah.
Okay?
Yes.
So now question is, it's not question, it's just a tagline. That is, there are two methods of finding out the allowance for uncollectible accounts. One is percentage of sale and aging of receivable. Remember that one. The balance is not equal. Here the balance is 98. In percentage of sales, the balance was 88. So it means if we are using percentage of sale method, allowance can be up or down, right? And if we are using aging of receivable method, the allowance balance can be up or down. So that doesn't mean that these two methods reserve the same allowance balance, okay? It can be increased, it can be decreased, okay? So you need to be very careful regarding which method you are choosing, okay? Now, let's just talk about the evaluate collectibility using allowance for uncollectible accounts. Let's just move forward. So, writing off uncollectible accounts. Up till now, what we have discussed? The allowance, right? The precautions that $98 million is not going to be received from Let me change the pen here. From $11,028 million. Not sorry, 11,000. Yes, this is aging of principal, aging of account receivable. Then it would be, let me clear this mess here. Because this is the method 98 we calculated from aging. So aging based on account receivable is $11,023 million. So this is a precaution, allowance. In advance, you make a precautions that $98 million is not going to be received. Right now, writing off means what if actual uncollectible happened? So assume that the beginning of the fiscal year 2013, Apple Incorporation has these account receivable. So we have a subsidiary ledger, RS, TM, and others. RS has to pay us $9 million, TM has to pay us $3 million, and others are $11,016 million. We have uncollectible accounts, $98 million. Now, what happened here? Okay, so our balance sheet will be showing that account receivable net of 28 and net of 98 is going to be 10,930, right? 10,930, which is 11,000 minus 98, right? Now, what happened? Early in the fiscal 2013, right, the credit department of the Apple Incorporation, they find out that RS cannot make its payment. We cannot collect, or Apple cannot collect from RS. So in the question, RS need to owe us 9 million. So it means $9 million actually happened. Or maybe RS is insolvent, bankrupt, they cannot pay us, so we need to make it expense. But remember, we already made the expense, right? When we created this entry, we already sent $88 million to income statement. If we send 9 more, then it would be unfair. Then total income statement gonna rise and our profit goes down. Because why? Because expense is gonna be negative from the sales, right? Sales minus expenses. We already included $88 million already in advance. We already included $88 million in our expenses, right? So this 9 million is going to be charged with our allowance. It means our allowance is now going to be decreased, not our expense. Expense already gone to income statement. So that is the beauty here of being a smart management, right? So you see, we directly charge allowance for collectible, right? When we charge allowance for collectible to account receivable, so we make a reverse entry. So RS need to pay us $9 million. Now they are not paying us, so we are deleting them. So decrease in asset is credit. So this 9 million is credited. Allowance for uncollectible accounts decrease. So it's a contra account of account receivable.